so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. As we move further into 2022, becoming a homeowner has gotten way more expensive. Now, essentially, in order to cool the housing market, the Federal Reserve has taken actions to cool it down, like skyrocketing interest rates, essentially rug pulling a whole bunch of buyers that were in the market to purchase a home, especially first-time homeowners or potential first-time homeowners. So a lot of people have already been rug pulled, but just how much have interest rates gone up, and how exactly has that affected potential homeowners' mortgages? So that's what we're going to look at today. And essentially, we're going to deep dive into an article by Redfin titled Housing Market Update. Typical buyer's monthly payment up 39%, the biggest annual gain on record. You guys, 39% increase in mortgage payment is outrageous, right? The massive rug pulling, surging interest rates, almost historical, right? Almost record breaking. Now, remember back in 1979 and 1980 when we had a massive surge of interest rates similar to what we have right now? That led to an immediate recession. And the reason why that's important is the overwhelming demand we have right now. Obviously, we won't have overwhelming demand if unemployment skyrockets, right? And if the economy crashes. Don't forget, you guys, I am not a financial advisor. I'm an opinion sharer. This is just my personal blog where I come to share my thoughts and opinions and things like that. But I am a realtor in Houston. I'm a loan officer in Texas. And if you guys could, please like this video, subscribe to my channel if you haven't already. And as always, please comment on my videos and share your insights with our community. Let's get started right now. Here's how the article starts. The typical home buyer's monthly mortgage payment shot up 39%, the largest year-over-year gain on record, as the average 30-year fixed rate hovered at a 12-year high of 5.1%. Redfin's data of home buying mortgage payments is based on asking price data going back to 2015. Rising mortgage rates are taking a bite out of pending sales as both buyers and sellers take a step back from the turbulent market. It seems as though the ratio of buyers to sellers remains mostly the same, which is why we have yet to see a substantial drop in bidding wars or the share of homes selling quickly. It's still early days, though, when it comes to 5% mortgage rates. The number of buyers willing to pay such high mortgage payments could evaporate by late summer. Now, if you guys remember, I have been anticipating that it will possibly be time to buy again and buyers' incentives will be back Q4, probably the end of Q4 of this year. But I also said come August and into Q3, we're going to have a lot more visibility of the direction of the housing market. And I have guessed that come August, we will have double the inventory that we had in May, which was slightly under 400,000. So I'm expecting to see in August 800,000, close to 800,000 listings on the housing market. Will that happen? I'm not sure, right? This is just my opinion. I don't have a crystal ball, but based on the data and these types of things, that's what I really think. Let's continue on with the article right now. You guys, one of the reasons why I love Redfin, even though I know they may be partially biased, is they have a lot of good data points that we're able to track that are basically leading indicators of home buying activity. So I'm going to read some of these for you guys, and I think these are really, really big indicators of the slowing of the housing market. So it starts, fewer people search for homes for sale on Google. Searches during the week ending April 23rd were down 6% from a year earlier. The seasonally adjusted Redfin Homebuyer Demand Index, a measure of requests for home tours and other home buying services from Redfin agents, was flat year over year during the week ending April 24th. It dropped 8% in the past 4 weeks, compared with a 3% decrease during the same period of year earlier. Touring activity from the first week of January through April 24th was 9% points behind the same period in 2021. 19% is a lot, y'all. Mortgage purchase applications were down 17% from a year earlier, while the seasonally adjusted index decreased 8% week over week during the week ending April 22nd. For the week ending April 28th, 30-year mortgage rates hovered at 5.1%. This was down just slightly from 5.11% the prior week, the highest level since April 2020. 10. So here's what's important, y'all. So even though we're just kind of going back to interest rates that we were at pre-pandemic, and technically we are at historical low interest rates, nevertheless, the rates right now are higher than they have been in over a decade. And remember this, that surge essentially happened in less than 3 months. Isn't the Federal Reserve incredibly powerful? And one of the reasons why we're having these surge of interest rates is selling mortgage-backed securities, right? So the more that the Fed sells mortgage-backed securities, more than likely that's going to cause our interest rates to continue to surge. So it's more than just the federal funds rate, actually, right? But let's continue on with the article right now. Now, here's a chart that Redfin made, y'all. This is homebuyer mortgage payments plus 39.4% year over year. Look at this massive surge, you guys. So since January to now, massive skyrocketing surge. And here is the rug pull. This is what the rug pull I'm talking about is right here. You can see how this is a lot more balanced as far as mortgage payments growth right here. It's a lot more balanced, you guys. This is just straight up. So essentially, they just turned it off for a lot of people. And again, I think the biggest people impacted by this increase here are the first-time home buyers or potential home buyers. But as you can see in January, we were under $1,750. Fast forward to April, you guys, $2,349. That is a huge increase from just 3 months ago. So real quick, just imagine that for a second. So 1 minute, say you put an offer in a new home build, right? And you were quoted a $2,000 payment for a new home build. Fast forward to today, that same house may be $2,600, right? As an example. Drastic increase, right? Drastic increase in expenses. And that's not even including all of the other expenses. And more than likely, that's also not including the additional skyrocketing property taxes and homeowners insurance. So when it all comes together, you guys, the Federal Reserve is taking a lot of steps right now that are making a profound difference in our housing market a lot quicker than I believe most people thought. So it's working. Let's go on to this next graph right now. Okay, guys, so here's the new listings of home year over year. So apparently we're down listings 3.5%. That's probably because there's nowhere for people to move, right? So there's no inventory. So that's kind of a wash for whoever's selling and buying. But I think this is probably here because of the inventory and also because of record low interest rates. But the thing that I want you guys to notice is this time of year, April to about September-ish, is when we start having our influx of inventory. Do you see that? So it starts about right here where this line is. This is like end April, beginning of May. So like right here, historically, you see here, 2022 is the red. 2020 is gray, 2021 is blue. But as we get past here, it starts going up, right? All of the inventory starts going up. So we're going to go into months as we move forward into 22 where we have historically an influx of inventory. So the next few months, y'all, are going to be really very big indicators of what direction we're actually taking in the housing market. And when I say what direction, I mean, are we transitioning back into that buyer's market? Are we cooling down? Are there price corrections happening? And most important, do we now have more inventory, right? So the next few months, we're going to start seeing a ton of data like that. And I, for one, I'm really excited, right? Because all of these things are finally starting to work. It's not all just cheap talk anymore, right? We're seeing actions take place that are having an effect on the housing market. And also, you guys, if you really think about it, 3.5% year over year, comparing to last year, that really isn't that much of a decline, right? But again, let's just keep an eye on Fed economic data graphs as far as the US housing inventory. And that should be out in a week or two, the new updated graph. And I will be doing a video on that. Now, I want to end today's video with just some conclusions and opinions that I got just from reading all of this data. So here's my overall opinion, you guys. I really feel like our housing market right now, and again, I know it's not the same as our housing market in 2008, not even close, but I really feel like our housing market right now is a house of cards. I really feel like it was kind of artificially created by all the free money, by the lockdowns, by the cheap money, by the stimulus, by all of those things. So I really believe, y'all, that all of these impacts that the Federal Reserve is doing, it's going to crush and destroy the housing market. And it's going to happen a lot faster than a lot of people are willing to accept and admit, because this is a COVID housing market bubble, right? This is from COVID. Let's just say it's from COVID. There's a whole bunch of other, factors fears that come along with COVID, but this is a COVID housing market bubble. We're out of COVID. There's no more cheap money. So I think it's just going to be crippled. And I honestly think that's what needs to happen right now in order for that transition to happen. Now, and then here's the other thing, you guys, and I've projected this and I've shared my opinion on this. I believe that a recession will be the catalyst, right? I think that the feds are going to do as much as they can to keep a soft landing, to keep it more of a cool down. But again, I just don't think it's going to be a soft landing, and I don't think it's going to be a cool down. And I believe a recession is going to be that catalyst. Now, I've estimated that we will start going into recession Q3 of this year. But guess what, you guys? Q1 of 2022, we had negative GDP. We already had negative GDP. So you can't say that the economy is great, right? Because we had negative GDP. If we go into one more quarter, if Q2 comes out and we have negative GDP, we are officially in recession right now, right? Right now, we could possibly be in a recession. So there's just too many factors going on right now that are pushing onto the housing market to cool it and to correct it that I think is just going to crumble, right? And again, you guys, I'm getting the house of card concept from the last 2 years, from the stimulus, from all the money printing, right? You guys can't really argue that, right? I know it's not like 2008. I would argue that the 2008 housing market, it was, I don't know if it was stronger because there were so many bad subprime loans, but I definitely think it could be as worse and possibly worse because in 2008, we didn't have all this inflation. So it wasn't necessary to increase interest rates. We could actually decrease interest rates. And that's what happened in 2009 and 2008. So anyways, you guys, I hope that you guys got something from my opinions. I'm just sharing my opinions. I hope you guys got a little bit. Each video that I make, I hope it gives you something, even if it's small. I hope it empowers you or click something and you guys just get better, right? Other than that, guys, this is going to conclude this video. I really appreciate you. If you're out there looking at real estate, I wish you luck and I hope you win.